the next couple of months through the corona period where we're all isolated at home, and then into Q4 where he'll be hosting, hopefully, the Energy Transition Summit physically again. Likewise, same for myself and the ESG investments team. We're hosting a number of ESG relevant content over the summer, so please do look out for that if you are interested. So there's been a fantastic number of sign-ups for this podcast, over 1,600, which is fantastic. And given the current situation with COVID, it is so crucial that we continue these conversations to share these insights and to keep the agenda for energy transition, really moving forward. As COVID's, really emphasized the vulnerability of companies and countries to these systematic shocks. And whilst the climate crisis might be slightly played out on a slightly longer time frame, the failure to act will, reveal these vulnerabilities in our companies and our investments as well. So to that regard, please do actively participate in this conversation today. Please do ask your questions. We will try to get to as many of them as possible. This episode is going to be focusing on the financing the energy transition. And if we're to stick within the Paris targets, we are estimated to need around 70 trillion of investment in decarbonisation over the coming decade. So it's really sort of the trillion-dollar question is where the cash is going to come from, and where it's going to go as well, where we're going to spend that cash. And to explore this today, we have three fantastic speakers to join us. We have Joost Bergsma, who's the CEO and managing partner of Glennmont Partners. We have Olivier Warnen, who's the investment director for the energy transition at BNP Paribas. And we have Stuart Broadley, who is the CEO of the Energy Industries Council. So just to outline the format, we'll be starting with Joost, then moving to Olivier, and finally to Stuart with a short sort of introduction before we get into a much wider discussion. And at that point, we'll be able to bring in as many questions as possible. So please do keep sending them in throughout. So Joost, thank you for joining us here today. It'd be good to know a little bit about yourself, and then also about the work that Glennmont are doing and the position that you are positioning yourself in the energy transition space.
Yeah, thanks, Dominic. Appreciate you giving me the opportunity this afternoon. And so I'm the head of Glennmont, one of the four partners, and the CEO at Glennmont Partners. We are a fund manager, and we focus exclusively on the energy transition, and specifically we focus on the power generation side of the energy transition, which so far has been one of the most active spaces. The panel is about financing the energy transition. We at Glennmont, what we do as a fund manager is we collect capital from institutional investors, so equity capital, and we invest that in the energy transition space. We've been doing this quite successfully for the last 10 years. We have about 50 odd clients. Our client base comprises of pension funds, insurance companies, and large sort of banks and fund of funds. Over the last 10 years, we've raised now a series of equity funds, unlisted funds. We raised a record fund last year of 850 million euros that we're now investing. You may see us from time to time in the news with our first fund, where we're divesting some of those assets that's at the end of its 10-year life cycle. Over the last 10 years, we have made 25 investments across Europe in onshore wind, offshore wind, bioenergy, and also solar. So we're active here in the UK. I'm calling in today from London, but we're also active in Portugal, Italy, France, and a number of other European countries. We have about 45 staff here in London, working from home today, of course, and our portfolio, I think, offset about 250,000 tons of CO2 or so over the last year. So that gives you a quick intro of myself and Glennmont.
Apologies, I muted myself there. Yeah, thank you for that, Joost. Great to have you, and yeah, good introduction. So, a couple of questions then to kick things off. Talking about the sort of the timing of the energy transition, and this is really quite a good question for the current period that we're going through. Obviously, a lot of things have been disrupted. A lot of change has, fundamental change to the economy has taken place due to the COVID period. So, understanding at what sort of pace is the energy transition moving at right now? What are the main and primary drivers that we're seeing, and what sort of time frame are we looking at for this?
Yeah, look, it's clearly a very good question. So I have to start, as you did in your introduction, a little bit about sort of COVID-19, in the sense that today, right now, there are many uncertainties that of course we don't know yet how they will play out when it comes to the energy transition, including things like how long the lockdown will be, the economic impact, and so on. But if you step away from all of that a minute, I would say that the energy transition already pre-COVID-19 has gathered pace, and I think it will continue to gather pace post COVID-19. It's not immune to COVID-19, but if you look at some of the key drivers that drive the energy transition, those haven't gone away because of the current crisis. If you take them into a couple of different, two let's say different dimensions, if you look at it from the investment side, i.e. we as a let's say a fund, but also other investors, what is driving the investment side? The key drivers that were there a month ago or so are still there. The first one I'd like to mention is that the cost of clean energy has come down enormously over the last 10 years as a result of feed-in tariffs and as a result of an enormous investment in capacity to build wind turbines, to build solar panels. The cost of producing energy from clean energy such as solar and onshore wind is really come down, and it's probably the most cost competitive form of power generation there is in globally, more competitive than nuclear, more competitive than gas. So that makes it, simply purely looking at economic reasons, something that isn't going to go away, because if you want to generate electricity, you clearly look for the cheapest source. The second thing that still hasn't gone away, which was one of the key, initiators for the whole clean energy transition, climate change. If anything, I would argue, let's say, that the concerns around health may become more focused as a result of this current crisis. So climate change is still there. The threat of climate change, the impact it can have on our daily lifestyle, still is there, and we've got to act. And power generation is still a big polluter, so we have to clean it up. A third one also came into focus over the last couple of weeks, which is a driver for the energy transition, which is the desire to be energy independent. You have seen the Russia Saudi oil talks and how big a shock that was, let's say, on the markets, in addition to COVID-19. So one of the big reasons, in addition to climate change, we're doing so much clean energy is energy independence, being independent from Russian gas, Saudi oil. And again, let's say, if anything, I think that's come even more to the focus over the last couple of weeks. Another thing that I'd like to highlight, and we'll probably talk more about it in this panel, is that whereas the focus in the last 10 years was much more about power generation, I would say that in the last 2 years or so, the focus was more on enablers. So batteries, storage, metering, interconnections. And also there, we've seen big gains in cost. So looking at these drivers, on the investment side, they're still there. They're not going to go away. And based on those drivers, I expect the energy transition to gather pace. If you flip it around and look at more at the capital side, the capital that is available to be invested, I would say again that sort of before COVID-19, there were big drivers. If you look at my side, the equity side, a lot of institutional investors put climate change very high on the agenda, and were very keen to deploy capital simply because they were concerned about the impacts of climate change on their portfolio. So that appetite from equity investors hasn't gone away. That capital is still there, and the same applies to the lenders. I mean, we've seen lenders stepping away from coal. and nuclear and so on. So the availability of capital for dirty energy is drying up quite quickly. So those two things combined, the opportunity on the investment side, and then let's say the availability and for dirty capital drying up, I think make the energy transition gathering pace, I would say, over the next couple of years. Time frame, clearly we have to act as fast as possible, but it's going to take us 15, 20 years or so to get, let's say, to really make big impacts. But that is not to say that we shouldn't start today, and we certainly should not stop today.
Mm-hmm. Excellent. So, I mean, you mentioned then couple of about the sort of the enablers of the energy transition as opposed to the generational assets, and I'm curious to see, you know, where you see the market opportunities and the opportunities for yourself as an investor. You know, is there opportunity within the enablers? Is it still within the generation assets or the generating assets? Or is it in, you know, what you said before about the sort of the desire to be energy independent? Are we looking at, you know, these new and emerging markets to prop up sort of, or what's the word to say, to place renewable assets into these new markets? Where are the general opportunities that you see?
Yeah, look. So the good thing, when we started 10 years ago, there was only one or two opportunities to invest in clean energy. Essentially, the only opportunity was investing in new wind parks, new solar parks, and so on. Now, 10 years forward, the opportunity set is actually very broad. So to answer your question a little bit differently, it really depends on your risk appetite. But the good news is that today, the energy transition and clean energy in particular offers investment opportunities across the risk-return spectrum. So if you say, well, actually, I'm really quite concerned today about all this market volatility and I see share prices bumping all over the place, then investing in a power generation asset that is already operational and that has a feed-in tariff with a fixed price, inflation protection, where the revenue is really quite secure and operationally it's also been running for a couple of years, that more conservative asset is fully available. There are plenty of those available. They go at relatively attractive returns, and you don't have the volatility. If you're saying, look, I actually now have a higher risk appetite, then probably you should focus your investment side more to the more newer technologies. There's still a lot of opportunities in storage, in metering companies. There's a lot of growth in these companies that we've only begun to scratch the surface in those areas. So higher risk, but potentially higher returns. Then areas that today are a little bit more difficult because of COVID-19, maybe construction. So building a wind park clearly today is going to take a bit of time. I mean, construction of wind parks is exempted. The good news is that electricity is an essential service. So in most countries, construction of electricity can go on, but there will be some delays in that part of the value chain. But I would say development, operational assets are probably quite attractive. Clearly, also in the clean energy space, there are some dislodged opportunities. There are a number of listed clean energy players. Their share price in line with the market has come down, and you can start to query whether that sort of discount, uncertainty discount, is justified based on the assets that they own. So there are opportunities where let's say share prices are probably oversold. And there will be opportunities of people that may need, let's say, liquidity, that are sitting on fundamentally good assets, but just lack liquidity. So those are some of the opportunities that we at Glennmont are currently looking at.
Excellent. Thank you. Let's move to Olivier now, just in the interest of keeping the conversation going and leaving plenty of time for questions, which are already flooding in. So Olivier, would you please elaborate a little bit more about yourself and your role within BNP Paribas, and then the position which BNP Paribas is taking towards the energy transition?
Sure. Thank you, Dominic. Thanks again for the invitation. I'm really glad to be with you today. I mean, almost with you, as much as we can. Slightly different from Joost, we're a principal investment line within BNP Paribas, which means that we're not structured as a fund, but we're investing the bank's own equity. We do follow, or we've set ourselves similar rules or guidelines as a fund, but we have a bit more flexibility than one. Coming back to the origins of the line, back in 2015, at the time of COP21, BNP Paribas took certain commitments to support the energy transition. One of those commitments was to invest 100 million euro in equity into startups active in the energy transition. We have a rather broad scope of investment. In the past 4 years, we made 10 direct investments in companies in sectors like energy decentralization, sustainable mobility, storage, energy efficiency, and waste to energy. It is a global line, so half of our portfolio is actually in the US, the other half in Europe, France, Germany, and Switzerland. It's the companies we're targeting. I would describe our line as a climate play. We focus on technologies or services that would reduce the use of fossil fuels or allow for a reduction of CO2 or GHG emissions. And when we started the line 4 years ago in 2016, we decided to focus our attention on late stage ventures. So anything ranging from, let's say, round Bs. We felt at the time, at least in Europe, we felt that there was a gap in financing for those companies that were past the R&D phase, launching their product, just beginning, having commercial takeoff. And we felt that at this time, the bank's money would actually be at best use. It has slightly evolved, but still there's a lot of opportunities in that range. We've balanced our approach between software and hardware. It makes probably us a bit different from the traditional venture capital funds around. We like all of them. We are investing our LPs' money wisely, so we do like software and quicker return, CapEx-like business model, but we've also invested in several more industrial plays that requires longer and larger investment. So we're not concerned or too much concerned about CapEx-intensive companies or business model. And I think that is slightly different from what we're seeing in the market today. But because investing money is not enough, our mandate is also to support the growth of those companies by leveraging the bank's networks. Our own international network, obviously, but also the network of our corporate clients. So our role is also to, open doors for our startups, make them visible, push for their solution to our clients, and eventually finance their products around the world. Energy transition has really been a real thing within BNP Paribas for the past years, and we have supported relays in most countries and in many different departments of the banks, and they are really supportive, to help supporting the growth of our companies. Excellent. So that would be for this energy transition capital team.
Sure, excellent. So then these and the supporting the growth of even startups, and the question sort of lies is which innovations are the ones that you're seeing with the most potential in this space?
Not an easy one. I would draw a difference between potential as an investor and the potential impact of such technology. Mm-hmm. And because we've seen that in the past years, it has been very complicated to have, let's say, a new technology of battery finance. Raising funds when you're a new chemistry of battery chemistry is tough. We've recently made this very exciting investment in waste to energy technology. It's a U.S. company, and it's a gasifier, so converting waste into synthetic gas, so energy. And we've seen the potential impact of that technology is absolutely huge, and I think that's one of the issues that we need to solve. Waste management. So I'm not saying that's where you should put your money, but that's definitely where the people the most concerned about our environment should put their money. Otherwise, we've seen, few trends that I think have not changed with COVID-19, and there will be more digitalization. I'm thinking smart grids, whatever will allow us to get more resilient. So the grid is definitely one area where we need more resilience, especially with the increase of renewables, where we need to manage the demand as well. So digitalization, one. No surprise, security and cybersecurity, I think, will be one of the key topics of the coming years. And as Jos mentioned, we are seeing a good momentum in storage. So I'm not so more talking about new technology, but I would see hybrid energy storage where you add renewable production and storage. I would see that as something that is taking off. It has been a thing for a couple of years, but I think the economics and possibly there will be some incentive that will make that right now.
Sure. So, taking the sort of the current COVID period aside, and we're looking over the next decade, what would you see as the most sort of important factors for investors and venture capitalists to consider when navigating the energy transition?
It's getting worse every question you're asking. That one is really complicated. 10 years looks like a lot of things could happen by then. I would go for hydrogen as the next 10-year thing. We're on our side. We've looked at many plays on that ground. Really complicated to sense the time to market for hydrogen. Either as an energy source or as a storage possibility. But we're feeling the change even in Europe. It has started in Asia for a while. It has been in Germany pretty much more active than it was in France, for example. And we're seeing that as the next thing. So it will take maybe 5 years, but I will bet on hydrogen.
Excellent. Thank you, Olivier. I'll give you a little reprieve from my challenging questions for now. Moving then to Stuart. Stuart, CEO of the EIC. Stuart, would you mind giving us a little bit more information about, firstly, your role at the EIC, and then where the EIC is positioning itself within the energy transition?
Yes, thanks, Dom, and it's a pleasure to work with you and Reuters Events again. So I'm Stuart Broadley, CEO of Energy Industries Council, also known as EIC, UK's largest energy trade association. Started in 1943 by 13 companies who they were in coal-fired power generation as supply chain companies at the time. And wanted to expand and diversify into oil and gas. This is at a time where there was no oil and gas in the UK, so they looked to the Middle East, and we were set up to help them both export to the Middle East and diversify into oil and gas. So, well, things have changed, of course. Now companies want to diversify from oil and gas back into power generation, but absolutely, of course, not coal, but renewable. And so really, though, for us, we are and have been for 77 years in the business of helping us to diversify and export across the energy sector. We do that by events. We do 130 events a year, connecting companies which are largely supply chain companies with a strong focus on UK to clients around the world. We have a lot of data to help our members. We are a membership organization. We have 700 members, which is about 20% of the UK supply chain, and we have other companies from around the world also as members. And that data is covering CapEx projects. So we track about 8,500 CapEx projects at any one time on our system called DataStream, with a value of about $10 trillion worth of value. And these look forward from 0 to 6 years ahead. either projects already underway in the build stage or still waiting FID, but announced and likely to get funding. We also track, as part of our data, all UK energy supply chain companies, of which there are 3,500 that have more than £1 million of revenue. And we track not just who they are and what their growth is and what markets they're in, but also what categories of detailed capability they have, so that we can understand their transition journey, perhaps say from oil and gas to renewable and into the energy transition journey of beyond. So this is what we do. I think we would say that energy transition to us is just another part of the journey of diversification across energy sectors. We've just come out of a 10-year cycle, which was known as renewables, but it was really energy transition phase 1. And now, if you like, we go into energy transition by name, but it's really phase 2, where it moves into the next range of technologies needed to achieve the fast disappearing temperature limiting targets set by COP21. And we are passionate about helping companies to be a part of that process in the UK and around the world. The final thing we do, and I think might be of interest today, is we work with companies in the supply chain to understand what challenges they face in the difficult markets that we continue to be in. So we call these studies that we do with companies survive and thrive studies, and we are in the 4th year of doing detailed work across the supply chain to understand which strategies companies have successfully used in challenging markets to grow in spite of, or even sometimes because of, those difficult markets. And today, now more than ever, those lessons are vital for companies to learn.
Excellent. Well, I mean, just then to dig into a case which I know you are familiar with, which will be the offshore wind and the growth of it in the UK. I'm very keen to understand sort of how this sector has been able to establish itself so well into the UK. What was the role of government in that? And coming at this obviously from the financing point of view, how did this come about? How did the UK enable so much growth in offshore wind?
So the UK, of course, is today the world's largest producer of offshore wind, and I think would receive plaudits for that. But it's not all good news, because we may be the world's largest producer of offshore wind, but we use very little UK technology to do that. So when it comes to the topic of financing the next energy transition, one of the lessons I would like us all to learn, at least in the UK, but this would apply to any government, is how do you not just spend the money to decarbonize, but also convert that to value in your own economy. So over the last 10 years, the government did successfully put in a series of funding mechanisms, feed-in tariffs, CFD processes, to put out to tender on the open market for developers the chance to design, install and operate offshore wind farms. UK, of course, is lucky, in Europe at least, because it has Europe's largest renewable market, as defined by, from a wind point of view, the coastline and the sustainable wind. But it still was courageous and structured in its relatively speaking, year by year awarding of contracts for those developers. But as I say, in the process of awarding those contracts, it did not do enough, and I think the government would agree to this now as well, to ensure that the money that was being spent on those offshore wind farms was not just spent on developers and their ability to then sign up 20-year deals, but also on the development of the technology inside the UK, so that then the UK built an exportable capability in offshore wind in the future. And of course, if you look now at the kind of who's been the winner in that race, it was Denmark, through its own much better overall collaborative planning across industry, academia, and funding mechanisms, they were able to ensure a number of their companies set up from scratch and diversified into wind, onshore and offshore 10 to 15 years ago. And then those companies, testing facilities, universities with full capabilities, supply chains with full capabilities, so that when the large project started in the UK, they were the companies bidding for and winning. The UK government did at the time look at inward investment and actually bringing in some of those capabilities, and in the end the money frightened them away, I think, and so they chose to set up the demand signal for those projects very successfully. And I think going forward for energy transition, the government should have confidence that it can once again set up and fund a CFD program once again for the energy transition. It knows how to do it. It worked very well. And again, the challenge for it, though, is whether they can then this time, for whatever is the technology of the future, be it green hydrogen, blue hydrogen, nuclear SMRs, energy storage, floating offshore wind, there are many options. Perhaps it's some of all of them. But how does it make sure that we then retain that capability, or some of it at least, in the UK? And of course, the government was also, if it were to look at kind of potential opportunity, successful in securing COP26, which of course has now been delayed, we assume, by a year, but that will be in the UK. What an opportunity that is for the government to use that stage to then pitch its new investment plans.
Excellent. So, I mean, to take this then forward to sort of not just the UK, but looking at overseas markets as well, and the next phase of the energy transition, you listed quite a few different potential technologies which could become, part of an energy mix for any particular country. Talking there about sort of the need to invest in sort of your own technology from your own sort of roots and government's level of investment. I'm curious as to how the private sector gets involved into this level of sort of technology, which investment, which may be more risky, which may be more untried, untested. There's been obviously big disappointments in the past, even in the UK, with regards to tidal energy. So, taking forward these new technologies in different locations, how does the private sector work alongside governments to bring these to the fore?
The UK government has already put in place a series of mechanisms to engage with the private sector, and it is linking that to the main. So if we're talking specifically energy transition now, is linking that to where the main emitters are in the UK, which are around the large refineries, petrochem plants. So you kind of can guess where they are, and they're perhaps not where you'd expect they are. So, for instance, Aberdeen, the home of oil and gas now for UK, arguably perhaps even in Europe, is not seen as a high emitter. Of course, though, offshore in the UK, the continental shelf, there is a high emission zone with its own emission reduction target led by the Oil and Gas Authority. But onshore, the 5 emission zones are northwest UK, southern Wales, Teesside, Humberside, and the Southampton area, which are the main emission zones. So the clusters have been set up by the government, encouraged by the government around each of them, where the government is now feeding grant funding, and some of the funding is bid funding, some of it is directly granted funding, so that those regions which are working in a highly collaborative way, both oil companies who may be, if you like, directly linked to the major emitters themselves, but of course have a large vested interest in being part of the solution, also local supply chain, also academia, and some of the big emitters that we do have in the UK that are very involved in developing these new technologies. Those clusters are working together to solve problems, develop technology, develop supply chain in each of those places in the UK. And the plan is that then more and more money will be fed to those clusters by government through this awarded grant funding to solve specific problems directly to reduce emissions in those 5 places. So from a government point of view, quite clever. It's a direct outcome that emissions will reduce, but also developing technology in a small funded way in those areas. And the goal is that that will be consistent funding. And the answer to your question is, how can the government support the private sector? Well, consistency of funding is the key. And over time, perhaps over the next 2 to 3 to 5 years, those clusters will be encouraged to collaborate more and more to eventually bring together an overall UK capability for energy transition. And if you want to know what I think is the technology that is the winner, I'm a fan of green hydrogen, which is electrolysis, because I think blue hydrogen, which is effectively oil companies effectively collecting and storing the carbon through CCUS in its own existing facilities, is copyable by any country around the world. There's very little, there is innovation in it, but not that can be captured and held as one state versus another. So I think it'll be quick commoditized. Whereas green hydrogen, I think there's a lot of commercial opportunity for those that go fast and hard. So clusters, the government could be continuously in support and providing funding, and ultimately, I would hope, green hydrogen.
Excellent. Nicely summarised. I've actually just a question on that, and I've actually seen a few questions also coming in for the same question, basically, trying to pin you down, basically. What have been the most successful collaborations you've seen? So talking of these clusters, is there any sort of examples that you've come across which have been particularly stand out in their ability to both tackle the energy transition, but also do it in a way which has been quite financially successful?
I would say, so it's hard for me to pick one of the clusters because they're all working on different technologies. So the company that we most recently worked with is a company called Peel, for instance, which is in the Northwest cluster. They're doing amazing work around circular economy and around hydrogen, many other areas. But actually, I would say, if anybody's got specific questions, and they can contact me afterwards, because really each of the 5 clusters has its own specific strength, and I wouldn't say one right now is better than the other. They are all working on different technologies, all as important as each other.
Excellent, nice and diplomatic. So we can then open it up, I guess, to the questions that I'm receiving, which are indeed numerous, and quite a common question that we're being asked about is the impact of the OPEC price war, or the OPEC plus price war, and the huge reduction in oil prices. So, I mean, firstly, I guess I'll come to Joost, if I may, and if you are able to answer this one, what sort of impact is the reduction in the price of oil and the sort of the systematic shock which the price of oil and that commodity is going through right now going to have on the energy transition and the timeline for the energy transition?
Yeah, no, thanks. That is, of course, a highly topical question. So, and there's sort of 2 things coming together, right? Which is, on the one hand, we've seen sort of a drop-off in demand for, I'm talking here power generation specifically, so quite significant drop-off in demand of about 15% or so in Italy and Spain, and also, if I'm not mistaken, in the UK. However, just a side note, clearly, whereas we've seen, I read, for example, that there were only 7 flights in a whole week in Southend Airport, dropping demand and to nearly 0. In the power generation, even when economic activity, industrial activity drops to nearly 0, power generation is still running at 85% or so. So electricity will continue to be needed even in these pretty crisis times. There's still demand for electricity. What let's say, with respect to oil prices, we've seen a combination of suddenly, let's say, a drop in oil prices, and at the same time a drop in electricity demand. So when we purchase our wind parks, we do that on the basis of long-term cash flows and projections. So what we're seeing, the most direct impact of lower oil prices, that a lot of forecasters who forecast the power price over longer periods of time are reducing their long-term power price forecast. So that means if I invest in a wind park, I would expect indeed to see the revenue from that wind park based on those longer-term forecasts coming down. Having said that, so that means, yes, we do have to make some adjustments to how we sort of price and value wind parks in the short term. Having said that, longer term, like I said, I think at the beginning, I'm not concerned. Suddenly, let's say that people will go back to oil because now it's cheaper. In power generation, like I said, wind and solar already are extremely competitive and very, very cheap. And with the breakthrough in storage that we're expecting, it's going to be the default choice for power generation. So I don't think that there will be a massive displacement of suddenly gas-fired or oil-fired as a result of this drop-off in oil. We've been doing this for 10 years. We've seen the oil price at 100. We've seen the oil price at 20, and every year clean energy has grown. So I do not expect that there will be a massive impact on the growth of clean energy or the energy transition as a result of this. I think what is very, very clear, and it hasn't gone away, is that I was just looking it up, that let's say there are sort of 20 firms causing nearly a third of all carbon emission, and I think it's 90 companies causing about 66% of carbon emission, and those are all oil companies. So that concern around the oil sector causing all these carbon emissions hasn't gone away as a result of COVID-19. It's still there.
Okay. I'm curious then, if it's not going to affect the investment decisions with regards to investing in cleaner energy sources, will it affect the investment decisions when in trying to look at the, or reducing the carbon emissions of oil and gas? So reducing the environmental impact of the oil and gas emissions, given that oil and gas will still be a part of the energy mix for the next however many years, albeit now potentially off the back of the COVID crisis. And I've seen a few predictions that peak oil has been brought forward as somewhat in a few people's minds. So will it affect the appetite to invest in these sort of carbon reduction measures?
So look, I think yes. Even pre-COVID-19, there was strong appetite for clean energy. Clearly, let's say that the focus after COVID is settling down, so to say, will be to get the economy going again. And I think clean energy can be a big part of that. I think some of the initiatives that other people on this panel talked about, governments, I think will try to find infrastructure initiatives where jobs can be created, and electricity and some of these sort of new investments, I think, can play a big role into that. So yes, I think that clean energy will be part of the government-led resurgence to get the economy going again. You're right. Don't get me wrong. I'm not saying that we can just close down the oil sector. That is, of course, naive. That is not, of course, the point. The power generation, which was the biggest carbon emitter, is already starting to clean up. I think that is well underway. The next big sector that we need to tackle is the transport sector, and a couple of people mentioned hydrogen, for example, that can play a big role in that segment. So I would expect there to be good growth opportunities, and I do expect investors, institutional investors, very keen to support that.
Sure. I've got a few questions here, which I guess are linked to that, and decarbonising these other sectors. But what about sort of the carbon capture and storage element? I guess I can direct this one at Olivier. Where do you see carbon capture and storage as playing a role, or do you see it as playing a role? And if so, from where can we look to finance it? Is it from the private sector, or is this a government sort of interjection?
Extremely complicated to see a business case today on carbon capture. I'm not saying it doesn't make sense. It makes a lot of sense from an environmental point of view. But until the time you've got a price to that ton of CO2 you're capturing, nothing will be deployed on a massive scale, which is necessary. So the answer in my view, will not come from the technology, because the technology does exist. There are a few technologies here already in place, already available to capture the carbon, whether in the air or from industry. It does work, or cement, or concrete. You can put carbon and capture it and store it many ways. But until the time you've got a price for the carbon, nothing will really happen, in my view.
So this must sort of be led by government sort of initiatives to promote the private sector to engage with this. Is that what you're saying?
Yes, very much, very much.
Excellent. Okay, so another question here for Olivier. How do you structure your investments? Do you also invest in other funds, venture capital, private equity funds, with regards to the energy transition?
Yes, we've made 3 investments in funds. The reason for that, and the team was coming from the private equity world with a lot of competition, and we thought, building this new line, that we needed to to get a deal flow, we needed to be LPs and funds, and honestly, it's also a question of learning from professionals. So we made those investments. We're very happy with them. One in France, one in Netherlands, and one in the US. And I think that's maybe more the case for clean tech, but it's a very collaborative world where basically there's not enough money for the number of projects that exist and technology that need to be deployed. So there's a lot of collaboration, a lot of information sharing, obviously a lot of joint investments along the years. And that's, getting back to your initial question around which technology would make sense. Usually you need sufficient time and money to develop a new technology. And that goes, with that collaboration with different layers of private money from the seed to the later rounds. And so this collaboration, I think, is different from other sources of private money that I've seen. And it's typical of venture capital, obviously, but I think a bit more even in the clean tech sector.
So we've got another question here, is to what extent is the performance of the hydrocarbon private and public equity performance facilitating the diversion of capital into cleaner or clean energy? Again to Olivier.
Sorry, can you repeat that question again, please?
Sure. So how is the performance of hydrocarbon private and public equity facilitating the diversion of capital into clean energy?
Sure. I think it's really important to launch and support new technologies. It makes no sense from a pure financial point of view when you have to wait, let's say, a new technology of battery, getting back the same example. But if you need 10 years to get your technology from the lab to a pilot facility, no venture capitalist will invest in that, because there's a limited where you would make a 5 or 6x on your initial investments, have the means to support that technology for 10 years, build the 100 million euro line that is necessary to build, a scale factory for batteries. So my point is that public money is very helpful in supporting those specific technologies. I'm obviously always concerned about subsidies that would artificially support technologies that have no market or no technical ground to be there. And we've seen that in the past, obviously. A lot of project technologies that would make little sense compared to what exists or what existed at the time. And I think the public money needs to be extremely selective as well on which technology to support, and maybe gather or focus on few technologies and choose the one they really want to support and put more money in that, if it makes sense.
Yeah, I mean, I'd like to throw that one across to Stuart, if I may. I mean, what are your thoughts on whether governments and subsidies should be coalescing around single or a few different technology sources, or should we be looking to more novel technologies to help solve the energy transition and the carbon crisis?
Well, let's start by just building a little bit on Olivier's kind of answer to the question around hydrocarbon versus energy transition. I mean, let's be clear. Activism has driven a move away from attractiveness of oil stocks in Western Europe and selected other countries of the world, but not the whole world. So, I mean, firstly, it depends where you are in the world as to the answer to the question whether the oil stock is still, you know, of full value or diluted value. Obviously, here we are in Europe. For those of you that are listening in from Europe, then we are absolutely in a diluted stocks world, where that activism has now come through to society, come through to governments, where now the whole society is passionately, I believe, behind not just the concept but the reality of energy transition. But I state again, that is not the case everywhere in the world. So kind of one way of looking at where to invest your money is not just the sector but also the region. So if you then say, okay, if you don't want your money in hydrocarbon anymore, where to go? Then I do agree with Olivier that be careful not just to put your money into energy transition slogans right now, because actually this consistency and continuity of spend of project money, although it is coming from governments and not just British but other governments, it is relatively small and absolutely at risk of stopping at any time. Because at the moment, these seed-funded projects are there to assess the viability, the efficiency, the scalability of these technologies, and they will not all win. So it's very hard to predict right now which one will win. So I think it's kind of, you know, proceed with caution, but at the end of the day, where there are projects, then participate, but be careful not to scale beyond the size of that project, unless you've got something which is the kind of Tesla factor, you know, the technology which disrupts and supersedes the normal rate of technology growth. But those are rare. But I do think that's an exciting opportunity in the current market. And COVID definitely plays a part in this, which is in this sort of cycle we're in now, great uncertainty and a period of years, not months of, you know, of recovery time. What a time it is for real technology to shine through. And I think oil companies, who of course right now are under fire from all directions, but let's not forget they actually have access to finance and technology and skills and amazing supply chain capabilities. And I think one of the real solutions to this now is to get them fully involved in energy transition themselves. And BP is a great example of that, but there are others where they've made the statements and sort of brought their employees along with the idea that they want to participate in this process, in this journey, and they want to spend their money and their time being part of this problem, being no longer being part of the problem, being part of the solution, if you like. So, you know, so BP is an example. They have global carbon emissions of approximately 470 billion tons of carbon, which is the same as the UK approximately, which is kind of an incredible statistic. So you think, okay, how can BP do that? And if every oil company says they're going to make that change, that is a huge amount of money that is then going to be out there to try and find the technology solutions for the future. So perhaps I would say right now, if you're looking for kind of one signal, follow what the oil companies are doing, because they're under pressure like no one else right now.
Absolutely. And we've seen some great sort of technological forays from the oil companies like Equinor into floating wind and the like. And they've really brought some serious resources to that industry, to that emerging market, floating wind, to help prompt it along both in the technology state, but also in the supply chain as well. So I agree with that. I've got a question, Stuart, just around sort of the looking at these technologies, and when we look to bring in sort of the private sector into these technologies where obviously a return is expected, is there a danger that we are looking to more incremental improvements rather than to new and disruptive technologies which could be have a greater impact in the energy transition? Yeah.
Yes, I think you're right. I think even though this is an amazing time for disruptive technology, opportunistically, the reality is that the vast majority of companies and probably governments right now have other priorities on what to spend their money on, and may not take the riskier or investment heavy approach on these longer term technology plays. So I think, yes, you're probably right. In reality, we are now in a cycle now of a recovery, deep set recovery, where it'll be kind of, you know, debt repayment, skill retention, key client retention, survival for many companies will be the priority right now. But I say again that don't underestimate the amazing technologies that are in the minds and sometimes in the factories of some of these entrepreneurial businesses we have out there. And I think I just hope that when they do then seek the funding that they need, that they can get it. And I suppose that then comes back again to the role of government, because I think right now, you know, raising capital will be more expensive. And so I think that's again back to government needing to have a policy backed up by legislation and funding around energy transition, that's why I hope COP26 is this stage, or maybe even before that now with its delay, where they have the confidence and the clarity of policy to be able to state clearly, this is where we're going to invest. And when they see a company with a technology that takes them in the right direction, they are then ready to invest, as I say, backed up by policy and legislation. And I honestly think, sort of closing the circle, the offshore wind story I told before, they've learned that lesson and they no longer want to invest without making sure that the UK retains some of that technology itself for this second wave of energy transition.
Thank you. Just then quickly before we wrap up, to go to you, just wanted to take that question from the perspective of the private sector again. You know, is the risk appetite of the private investment sector, is it sufficient to enable investment into disruptive or more risky, less well-known technologies that may prove to enable the energy transition to progress at a faster rate? What I'm trying to ask is basically, given the current risk appetite, are we going to be able to achieve an energy transition in a practical and useful time frame?
Well, look, so starting with the last question, I think my view is yes, that if you look at institutional clients, pension funds, and insurance companies, and so on, they are very keen to continue to finance the energy transition, is my sense. I mean, they recognize that medium and longer term, the impact, the very bad impact of a very hot climate is really detrimental. And if anything, I think the current health crisis shows the impact, let's say, how important health is to everyone, right? So I think they will continue to direct large amounts of money to the clean energy transition. By nature, I would say pension funds, and you hope that everybody's pension fund is conservatively managed, they are more conservative. So larger pools of capital will indeed inevitably go to, let's say, more conservative parts of the energy transition, power generation in particular. But even small amounts of these very large amounts of capital can make a big impact on sort of newer tools. So to answer your question, yes, there will be capital from the institutional sector available to invest in more good technologies. So I'm absolutely confident that will be continued the case.
Excellent, thanks, George. Olivier, just to wrap up, then, do you concur with your confidence that you know, the private finance sector and the private investment sector has the risk appetite, has the desire and the drive and the information to be able to achieve an energy transition in a realistic timeframe?
I think so. It was happening before the crisis. I think it will keep happening, probably driven by the very low interest rate. So investors are looking for return, and return means higher risk. So we've seen with hydrogen, for example, we've seen a few projects that are being deployed and financed by banks, institutionals. So it's happening, and I think we're in a good way.
Perfect. Thank you, Olivier. Well, that's everything we've got time for today. I believe Owen's got another podcast coming up looking at oil and gas in transition. Obviously, there was a few questions today, quite a few questions surrounding oil and gas, surrounding OPEC. I'm guessing this will be covered in more detail there. So please do look out for that one. Apologies for the questions that we didn't get to. There were a vast number of questions, I can assure you. And I'm sure that Owen will try to incorporate some of these into future content that we can send out to fulfill the conversation over the coming months. But be sure to keep updated on the ETS pivot page for this. Owen will include a link when he sends out the recordings. But thank you for everyone for tuning in. Thank you for Stuart, thank you for Joost, and thank you for Olivier. Yeah, stay safe and stay healthy.
Great, thanks. Hope to see you in October.
Thank you.